Good morning, everyone, and welcome to our Commercial Real Estate Roundtable, the future of commercial real estate investing. I'd like to thank our hosts from Cushman & Wakefield Boerke for making this event possible and for bringing together such an esteemed group of panelists to share their insights with us today. Attendees, if you'd like to ask our panel a question, simply type it into the questions pane in the control panel, and our team will get that to me. My name is Mike Dockham, and I'll be moderating today's event. And I'd like to start by introducing you to our panelists. Alexi Panayotopoulos is partner and CIO at Fundamental Income, an institutionally backed single-tenant net lease REIT. He brings an extensive background in sourcing, credit analysis, underwriting, and real estate finance to our discussion today, with over 1.5 billion of transaction experience. Brad Sweeney is Senior Vice President of Acquisitions at Stag Industrial, a real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the U.S. His background includes managing an acquisition team in the sourcing, underwriting, negotiating, and closing of deals with a territory of approximately half the country. Jim Cope is the Executive Vice President and Managing Director at Walker Dunlop, a firm comprising a team of commercial real estate finance and lending experts that tailor financial solutions for commercial real estate investments. Jim runs the capital markets business unit, placing capital for income-producing properties, including office, apartments, hotels, industrial, and retail nationwide. Max Myers is principal and CIO at R2, a fully integrated firm managing all aspects of the real estate process. And Max oversees all investments activity for R2 and is responsible for the implementation of investment strategies, organization of new opportunities, debt and equity capitalization, and structuring joint ventures. Last but not least, Ben Adank is real estate advisor and a member of the investment sales and capital markets team at Cushman & Wakefield Boerke, where his 15 years of real estate experience contributes to his ability to focus on investment transactions and strategies, maximizing returns for his clients. The Boerke Company is the host of our roundtable discussion. For over 90 years, they've been a leader in Southeast Wisconsin's commercial real estate market, and they serve not only the greater Milwaukee area, but also Madison, Kenosha, Racine, and the Fox cities. Welcome, panelists, and thank you all for taking time out of your busy days to be with us today. Let's get right to our first question. It's a big one, and it's for all of you. How is 2020 measuring up to your initial goals? Brad, I'd like to ask you if you could lead us off.
Sure. First of all, I appreciate the invite. Thank you to Cushman & Wakefield Boerke for hosting this. You guys have been a great partner of ours over the years. We wouldn't have been as successful in Wisconsin without the help of a number of the Cushman & Wakefield brokers. So thank you. Obviously, it's been a very interesting year. That's kind of an understatement. I think we went into this year kind of expecting a similar year to 2019. In 2019, we acquired a little over $1 billion of industrial real estate. So we had pretty lofty goals. And I think we got off to a pretty good start, only to have to kind of immediately go into reverse in, I would say, the beginning to middle of March. Obviously, as a public company, and we do trade on the New York Stock Exchange under the ticker symbol STAG. The equity market started to get pretty finicky late February. And then began to downdraft in March. So the board kind of put us on ice, kind of told us to step to the sidelines just to kind of wait out the volatility that was occurring in the equity market. So we did that. We put acquisitions on pause. That didn't mean we put the rest of the company on pause because asset management got really busy through the pandemic. But from an acquisition standpoint, we took about a 60-day timeout. And then I would say we shifted into first gear kind of in middle to late May, poked our head out to see what was out in the market and available, kind of tied up some deals that we had under agreement pre-pandemic that we dropped, and then started closing deals, I would say June-ish timeframe. And then we kind of saw a fundamental shift in the marketplace, I would say in July, where I think a number of other investors started to kick the tires on deals and the capital markets guys started to bring product to market. There was really a period of time there where I think most of the intermediaries were advising their clients to just sit tight there's not enough buyers in the market right now, and I think that really changed as we moved through the summer. Right now, I would say we're probably in fifth gear, like a lot of the buyers. So it'll be a really back-end weighted year, but I think we'll end up about 70 to 75% of our original target.
Okay. Max, how is your perspective different from what Brad shared as far as the trajectory he just explained?
Well, echo Brad's statements. Thanks for having me. It's nice to virtually meet everyone, which is a nice segue into how weird this year's been. But I don't think anyone's going to jump up and say 2020 has been great or good. It's been challenging. We started the year actually out with a brand new fund vehicle. We're an owner operator of office product, some mixed use, mostly creative office in the Midwest, Minneapolis, Chicago, and Milwaukee. And most of that has been one-off joint ventures with institutional capital partners. And we launched a fund specifically to buy creative office across secondary markets, including Milwaukee. And that was launched in January. So it's going to be a boutique fund, $150 million. We raised about 40 within the first, call it 45 days of our launch, and then the world stopped. So from a fundraising perspective, we continued dialoguing with investors, but for the most part, for our asset class, and I know it's different in others, and I'm sure Alexi and people can speak to that, but for office and value add office, investors, both retail as well as institutional, are completely risk off. Their response is essentially, when we talk to them, why now? Why wouldn't I wait 6 months to see what's going to happen in the market? What is the opportunity? And for us, which is kind of the next measuring up to our goals, we're not seeing the transaction volume, obviously, that we thought we were going to see, but even at a small level, what we'd be comfortable with. So, kind of similar to what Brad was saying, we went in asset management mode from March to May. We came above ground kind of in June to see what was going on. We had a deal actually in Minneapolis that we had dropped during COVID because we were concerned about it, thankfully. And that came back to market in the summer. We're like, okay, there's a transaction here. Let's dig back into it and see what happens. And the bid-ask spread to where we were comfortable was insurmountable. And though we're seeing transactions and people kind of test the waters and opportunity per se, the ask doesn't reflect, which I'll get into in the next question, how we have to underwrite deals and kind of how we're seeing the world. So 2020 has been obviously very tough. There are transactions we can't figure them out because of pricing, and from a capital raising perspective, it's been slow. But I think everyone on this panel and probably in this room is hopeful that we're at the tail end of what's going on, and specifically 2020. So hopefully 2021 is not a mirror image and we can turn half a page at least.
Yeah. And Jim, what about at Walker & Dunlop? What have you seen there for 2020?
Again, thanks for having me, Ben and Cushman and Wakefield. It was really interesting. We had very bullish goals for 2020. Particularly in the investment sales side, as we've invested heavily in that part of our business for multifamily investment sales, as well as on the capital markets group that I run. We actually started the first quarter, just with the biggest volume quarter I think we've ever done. So our capital markets group was setting records. Our investment sales side was off the charts. And then COVID hits in the second quarter and it's basically crickets. I mean, deals fell apart, a lot of deals walked away. So second quarter was really a big pause for us in the market. We kind of put pause on our bridge program. That's leveraging our balance sheet because we are also a public company. So we leverage some of our capital to do bridge lending, et cetera. So that kind of came into play, and but at the same time, because we're such a heavily multifamily centric platform, the agency side of our business, the multifamily component really kicked in. So even though our capital markets group pulled way back on our brokerage finance business, our investment sales business fell off dramatically. We still held up really well as it went in terms of second quarter performance, and actually, stayed on pace to, really track to the goals for the year. And as we kind of got through the second quarter, the third quarter's picked up, investment sales have picked up, especially, again, we're only in the multifamily investment sales business, so that part of the business has picked up dramatically. The bid ask went back to close to pre-COVID levels within, I would say by August, September, we're back to pre-COVID levels. Cap rates have actually compressed because of the cost of capital dropping so significantly. So our third quarter has been very, very strong, and we think the fourth quarter will be equally as strong, although there's a lot of volatility that's coming. I mean, there's a lot of volatility. We're seeing it right now pick up. We'll talk more about that in terms of interest rates, et cetera, but we actually think we'll end up, meeting and beating expectations for the year based on what we're seeing so far. So surprisingly, it's actually been a very good year, primarily because we're so multifamily centric.
Alexi, with being such a new company, can you talk a little bit about what it's been like, kind of entering into as a new player here at this time?
Yeah, absolutely. I'd say it's been a wild ride. Launching a company virtually during a pandemic in the institutional capital space, kind of as Max alluded to, is very interesting. We launched at the end of April of this year after raising $500 million of capital from Brookfield Asset Management in New York, and really had the goal of establishing ourselves in the market. Myself, my other 6 partners have all been in the institutional capital and net lease space for quite some time. But our goal really in 2020 was to put our flag in the ground, travel the country, hit every conference, hit every city center, financial center possible to really introduce who fundamental income is and what we're looking at doing. And that really took a turn when the pandemic hit. We were supposed to have a partner based in New York and one in Minneapolis traveling. And so we've sidelined all that. We're doing everything virtually. From an AUM perspective, we've been able to close a number of good transactions. It's certainly been slower than we had expected. And the bid-ask spread that Max and Jim have alluded to is certainly present. For us, we focus on single tenant net lease real estate across the United States, which includes everything from child cares and schools to gas stations and C-stores, restaurants, even potentially movie theaters and entertainment centers. And so as you could imagine, our market has almost evaporated because it's almost impossible to price a building that has zero attendance or foot traffic. And so to Jim's point, we've seen cap rates compress on the essential and open and operating businesses like industrials and like e-commerce logistics focused businesses, et cetera. So for us, it's been certainly a very fun year to get out, but also bittersweet with everything going on in the world. But right now we're just working on closing our last couple deals for the quarter and put our eyes on 2021 to see what that will bring as a new company.
Mm-hmm. And Ben, I mean, it's definitely an interesting time for you to be getting back into brokerage. So what's your experience been like this year?
I think it mirrors a lot of what Alexi had to say. We had pretty high hopes entering the marketplace. It was definitely very robust as you ended 2019, looking into 20. The big adjustment, to Alexi's point, is traditionally how a lot of people network within the industry, you weren't able to do. So you're looking at how you connect, how you find deals. It's been very interesting to try and recreate the deal flow model. But overall, deal flow, it's definitely down on the investment sales side. Boerke, we've been very fortunate. We had a pretty good leasing pipeline that we were able to fulfill throughout the year. So overall, the company, I think, is performing in line with expectations for what they had for 20. But the investment sales side is definitely down. Haven't seen much activity. A lot of sellers just holding off, trying to figure out what they should do, whether now is the time to sell or whether they should just wait for the pandemic to kind of roll over and head into 21.
Mm-hmm. Yeah, with that, I think something that we've all come accustomed to this year in all walks of life is that uncertainty, and then hopefully now kind of giving way to things that feel a bit more familiar, and then looking forward to a light at the end of the tunnel at the end of this year. Our second question has to do with the new normal that we're experiencing with respect to interaction in the office space. And Max, earlier you talked a little bit about underwriting standards. How is that new normal affecting your underwriting standards, and what do you anticipate office usage will look like going forward from an investment standpoint?
Yeah, if I could virtually put a finger in the air, I think that's probably my answer. But we're trying to prognosticate around work from home and its effect on office is pretty difficult. I think that the headlines coming out that work from home has been as efficient as working in the office for some companies, I think is overstated, because it's pretty easy to be efficient and accountable when you're worried about being fired and put into this sort of employment environment. So of course people are gonna be perceived to be working hard and kind of do more than they normally would because they're concerned about the ramifications of that. In addition, with lockdowns, et cetera, there's not a lot to do. So yes, it's easier to work from home when there aren't as many distractions. So I think a lot of the people that are trying to prognosticate around work from home, its effects on office demand, it's a little early to see trend lines. I do think there's going to be some offsetting between lower density in office spaces, not packing people as tightly, and the square footage per employee increasing, and that offsetting some lack of demand, but we'll see. It's really hard. So from an underwriting perspective, when we're looking at a new deal, rental rates and absorption pace are always the first two questions. And we've been pretty conservative, trying to anticipate when demand will pick up and if rental rates will be what they were in early 2020, or if we're going to see some sort of dip and then a ramp up to come back to it. So we've had a hard time buying deals, being kind of having a meeting in the mind between seller and buyer, where we feel comfortable underwriting something with those two components, and where sellers see value and maybe looking in the rear view mirror as to what they're marking things on their books at in the first quarter of 20 versus what the implication of these revised assumptions would be on value. But we're confident that for what we do, which is really non-commodity, creative office, horizontal campuses, a lot of parking, a lot of outdoor space, not just traditional workforce tower officing. We think that creative office and those sorts of products that offer something different and offer a compelling reason to return to the office space will be leaders in the field and in the sector.
Well, what about near-term interest rates as part of that? I mean, what are you forecasting? And then, if you are thinking it's a moderate increase in rates, how might that impact cap rates for future deals for you?
Yeah, I mean, I'll give you a live example of the deal that we were working on in Minneapolis. We had bank financing that was ready to go at L plus 175 in mid-February for a transitional office deal, lease up play, 65% leverage, 65% of cost, non-recourse. When that deal came back to market, as I'd said in June, we went back out to the debt markets. Banks were gone, life codes were gone, debt funds were still around, but their spreads were, call it 150 to 200 basis points outside of where we had locked in financing. So on our purchase price was a 15% hit to value. No other changes made to what we were looking at. So just the effect of spread on transitional office deals. Now I understand industrial and multifamily, as Jim can speak about, have been much tighter, but for anything that has a little opportunistic flair to it, or
sounds like Max's audio is
hard to
cutting.
underwrite.
Jim, why don't you go ahead and take the baton then from Max and see you up on that one.
Sure.
Sorry about that.
Sorry. Speaking a little bit in the office usage as well. I mean, we're a company that's assessing that as pretty significantly, and I think Max is on that point. Is we're pausing to see what our usage is, but I do think we're going to be taking more space per employee. We'll have less employees probably coming in, but I think we'll net, I don't see us being a dramatic retractor, even though we've been extremely effective and been able to maintain and increase our productivity and production during this whole pandemic while we're working from home. So the technology side was very supportive for that. So that was a interesting test of all this. But as far as interest rates, Max is on there too. I mean, obviously the market's come back a fair amount. The third quarter or the second quarter, the banks and the life companies pretty much disappeared. The debt funds were on the sidelines. I mean, they were under a lot of stress if they had repo lines and things backing their positions. I mean, it was a pretty stressful situation in that environment. So when you think about interest rates, I'm less concerned about where the base indexes are, LIBOR or US Treasuries as kind of the core metrics or base indices. There'll be some volatility there, but I think, for the near term, because it's hard to say, and I don't know, I'm just going to give it my best guess and kind of where the market perceives it, is that over the next 12 to 24 months, indices will tend to stay relatively low. But it's really more about the spread on pricing and where that's going to go. And obviously, Max saw a huge bump out in spreads of 150 to 200 plus basis points. Now, today's markets, the spreads are still considered relatively high. Historical norms would say somewhere in the 150 range on spread, the credit spread to treasuries or LIBOR as a kind of a base case. So we're running well north of that, but we're also at an unprecedented levels of treasuries and LIBOR. So, that we're running 50 to 100 basis points wide of that is, I think, not uncommon or unexpected given the index levels. So what we could see, assuming risk isn't on, where risk is being priced into the market, that there's more risk volatility going forward, we could see some movement in the indexes, but see some compression in spread. My concern would be is that we're going to see more volatility and more uncertainty as the markets kind of settle itself out over the next 12 months, that potentially spreads will stay wide and potentially even widen. And we are coming into the election, we're seeing some widening right now, even while the treasuries are rising. So we're seeing spreads go up and treasuries widen at the same time. So we're seeing, real interest rates moving up just in the last week or two, 25 basis points.
And Jim, I would throw this out at you as well. In talking to a lot of the local companies here, they're dealing with local banks, not the sophisticated life companies or debt funds, where they're having a significant amount of increase in the covenants that banks are putting on them. Trying to cross-collateralize real assets just to protect the bank, but that whole credit facility seems to be changing from an operator standpoint as well. And they're starting to look to real estate as a solution to try and help them bridge the gap, because the banks are, I don't want to say taking advantage of, but they're definitely being a little more aggressive on the local lender side.
Yeah, I mean, the banks, as I say, risk on, they're definitely risk on. We just had we're trying to place a deal just recently, and the bank goes up to the president and he turns the deal down cold. I mean, there's just a lot of it's very tentative in the market, especially in the banking side. And that's not unusual. I mean, the banks can be pretty fickle in general, we found, but it's even more so today. So I still see that the banks are seeing a lot of risk in the markets and are being pretty conservative as it relates to how they'll transact, which definitely is putting stress on the system. It's making it difficult to get development loans for new construction. The credit markets are definitely tight when it comes to the banking market.
Well, our next question is a submission from the audience. And so as a reminder, those of you in the audience, you can submit your questions using the control panel. And Molly asks, what is your view on inflation risk and how will it impact the investment real estate market over the next 5 to 10 years? Alexei, you're starting to build a portfolio. So how do you think inflation will play out over the investments you're trying to buy?
Sure. For us, it's a little bit different than maybe traditional multifamily or office or industrial that have a little bit shorter lease term or value add when it comes to the actual purchase of the property. We're in the single tenant net lease space where we're looking at signing, on the low end, probably 15, 20, 25-year leases. So for us, we're locking in longer term paper. And so, inflation and interest rates have always been on the forefront of how the public net lease REITs and even private net lease portfolios are valued. And so to Jim's point, we've certainly seen quite a bit of tightening on spreads with essential type properties where banks are willing to go risk on. But to Ben's point, there's quite a bit of structuring going around within in paper, and part of that is inflationary protection. Part of that is, there is a floor and a cost of lending where whether you have a 10-year at 50 basis points or now rising above 80 and climbing back towards a little bit of pre-COVID levels, we really focus on how can we factor in rent bumps, how can we factor in CPI within leases, and tenants have been extremely understanding of we're in an unprecedented environment, and so for us, we don't focus or we're not scared of long-term rates or inflationary pressure, but you definitely have to think about it when you have $6 trillion of money supply in the market that, where you used to have sub 10% money supply, now you have close to 15, where you've never seen it in history. It's a little bit interesting as to how that may unfold over the next, 5, 10, 15 years.
Great. Okay, well, at this point, we're actually going to give the panelists a quick breather, and we're going to put our audience on the spot. We have a poll question for all of our attendees. So at this point, I'd like to bring in our technical expert, Eric Johnson, and he's going to introduce the poll and explain how to participate.
Thanks, Mike. Eric Johnson here. The poll should be on everybody's screen, and the question is, how do you anticipate commercial real estate inventory levels for deals during the remainder of 2020 and looking into 2021? And you can choose one of the following 5 options: greatly decreasing, slightly decreasing, flat, slightly improving, or greatly improving. And we're going to wait until we get about 50% on this mic. We're currently at 17%, so come on, audience. 39%. Keep climbing. 50%. I'll keep her open for another 6 seconds. 5, 4, 3, 2, 1. And if you haven't voted, hurry up and get that in. With 67% voting, here are your results.
Okay, so we see at least the tendency going in the right direction, right? With the 2/3 feeling that it'll improve slightly, another 17% improve greatly, and then the remainder saying flat. So nobody sees this decreasing. So what I'd like to do is just a quick around the horn with the panel here, guys, speed round style, 30 seconds each. Hop in and let us know what you think. Same question, or if you want to chime in on people's kind of optimism here. Jim, how about you?
Sure. Well, I love everybody's optimism. I'd probably say I'm in the flat category just because it's really hard to predict. There's just so much volatility out there. I hope it goes up, but I still think there's some headwinds that could cause us to go the other way. So I think net we're kind of in I'm in a flat perspective.
Brad?
Yeah, I'll answer this from the industrial standpoint. I think deal flow we saw a massive surge for deals to kind of get closed year end here. I would expect deal flow to decrease as we go through the end of the year on the industrial side, and then I expect it to ramp up probably pretty significantly as we kind of enter into January of 2021.
How about you, Ben?
I'd say slightly improving. I think there's a lot of interest, and we're getting it to start to come to market, and you'll see I think a bigger bump as you head into 21.
Okay. Alexi, what's your outlook?
I'm kind of in the same boat as Jim. I'd say flat to slightly improving. There's a lot of headwind as far as COVID expanding in Europe, elections coming up, year end coming up on us. But I will say in 2021, with a little bit more clarity, I expect that to improve from a deal flow perspective.
Max, you got the last word.
Yeah, I think everything from an office standpoint that was going to come to market is in the market right now. So flat, I would say, from an inventory standpoint. I think 2021, you'll see more deals come to market, more inventory. But I think in terms of actual transactions and transaction volume, I think flat to slightly increasing. But I don't think you're going to see a huge jump. More listings, not as many transactions.
Okay. Yeah, so sort of a consensus here, maybe that it's somewhere in between the flat to slightly improving, hopefully. So our next question is specifically about Wisconsin. I know we've got some different perspectives and points of view here from our panel. The question is, does Wisconsin offer any inherent CRE investment advantages or shortcomings? And then, kind of what about the upper Midwest region in general based off of that? So, Brad, why don't you go ahead and take the first one on this?
Sure. So we've been an active investor in Wisconsin since 2004. I think today we're probably the largest industrial landlord in the state. So we've kind of witnessed a few cycles. We've kind of lived through a few cycles here. I think one of the reasons we're here and deploying, capital in the state relative to other secondary markets, and whether it's in the upper Midwest or across the U.S., is predominantly driven by yield. I think we find, all things being equal, we can buy Class A buildings at probably 100 basis points wider of Chicago, and wider of most other markets in the country. So number one, it's yield driven. I would say number two, it's probably we like the supply and demand dynamics in Wisconsin. We have for a while. It's a market that, for the most part, doesn't generally get ahead of itself because there's not a lot of merchant builders here. So it's a pretty controlled development cycle. And then third, I think most, and I can't say this for every building we have, but we've tended to find that retention, Wisconsin tenants tend to stay in their building. They're here in the state for a reason. It's not generally where you would locate a national distribution facility. So you're not really competing against other Columbuses and Indianapolises of the world. So we've had a good experience with tenant base and tenant renewal. So I think those are the kind of the three reasons why we like Wisconsin. I think things that kind of maybe shortcomings, if you want to call them those, I think Wisconsin tends to be a little sleepier. There's not as much on the market for sale here. You really have to kind of dig deep to find deals. You have to do them off market, so it takes a lot of work. And that's maybe why some institutions have stayed out of Wisconsin. And then secondly, I would say from a leasing transactional standpoint, Wisconsin has lagged other similar size secondary markets in this cycle. There is nowhere near as much leasing velocity in the state of Wisconsin or in Milwaukee as you'll find in other similar sized industrial markets. And that's what we've noticed so far this year. So
okay, well, Max, with you being based out of Chicago, keep in mind we got a largely Wisconsin attendee audience here. So football notwithstanding, what are your thoughts on this issue? Advantages and challenges of Wisconsin.
Yeah, we were seeing trend lines pre-COVID that secondary markets, including Milwaukee and others in the Midwest, were starting to see both employment growth as well as population growth, at least from an urban standpoint. And the reason for that is I think employees and people graduating college have started to take a step back and look at where they want to spend their life now. Obviously, New York and San Francisco and Los Angeles are really exciting, but the cost of living there is so egregious that if they can have great quality of life in a secondary market and get a really good job and make an income that's potentially less but comparable, that's a lifestyle choice that we're seeing people make. I think that trend line's accelerated post-COVID. You hear a lot of urban to suburban conversation, but I think it's less urban to suburban and it's more primary to secondary, where kind of easier quality of life cities such as Milwaukee, when people really dig into the Third Ward or Walker's Point or some of these neighborhoods that are really cool and they spend time there, and especially kids that are from Milwaukee or Wisconsin area that come back and experience Milwaukee, and a Milwaukee that they didn't really see growing up, because a lot of the urbanization has happened in the last 5 to 10 years. I think people are saying, hey, this is actually really cool. I could live in the Third Ward and have great restaurants and breweries and a nightlife, and this is a great option for me. So I think Milwaukee specifically will be a beneficiary of a flight to secondaries, and mostly because of quality of life. And you're seeing that in the primary secondaries, Nashville, Raleigh, some of the smile cities where you have great weather and another kind of element that's drawing people there. But I think Midwest secondaries will see some of that trickle in as well.
Interesting. Ben, with Boerke being right here in Southeast Wisconsin, what's your take?
Well, I think Brad and Max have really hit on a couple key elements that Milwaukee, sleepy, I guess is a good word for it, but it's very consistent. So we don't have the wild swings that you see in some of the other larger cities from a vacancy standpoint, from a rate standpoint. It's fairly predictable. It's why a lot of institutions do like to buy here, because they can kind of count on what they're going to get from an investment in the Wisconsin region. I was fortunate before I came back to Boerke, I worked on the principal side for a company that was in Minneapolis, St. Louis, as well as Wisconsin. And there was an attraction to Wisconsin because of the predictability of it, but also because you have an environment where the government was behind you. There are tax incentives to get those companies to come across the border. The whole reason Kenosha had the explosion that it did from an industrial standpoint, you're starting to see that in Janesville and Beloit as well. So we have good infrastructure. We have relatively, let's say, relatively cheap cost of living, taxes aside. But I think the one thing that gets overlooked as companies look to come here, which is going to help drive the real estate side of it, is we have a great workforce. People don't like to mention it, but we did have 2 huge automotive plants in the southern portion of the state. And when those left, we had a massive amount of employees that were able to be a massive selling point for companies to come here. And you've seen them take advantage of it, specifically in Kenosha, and you're starting to see it in Janesville. The workforce that we have is a massive asset, and can't stress that enough as to why companies want to come here and put down roots.
Well, if we, looking forward then, right now we're all confronting change when it comes to employees working from home. And so, we talked a bit about like how that changes in the office structure and so forth, but how has the prevalence of work from home impacted productivity in doing deals?
I touched on that briefly, but I can jump in it again. I mean, fortunately for us, our technology support was intact to a level that we were quickly able to go remote, and really not lose anything in the way of productivity. Actually, a lot of the complaints we get now is that people work from home don't know when to stop, because there's no time to go home. You're already home, so you just all of a sudden you're working, and you maybe get dinner and you're still on your computer doing deals until 11 at night. So which is not what we want to see happen. Obviously, we want to see a good work-life balance with our team, but it really hasn't hurt us. I think we're going to be very thoughtful as it relates to how we get back. Actually, my office has been open since mid-June, and at least 50 to 75% of the people are coming in, but they're not coming in necessarily every day. If there's a reason to stay home, there's some other thing going on, then they work from home. So I see it more that we're going to have people working both at home at times and at the office, and maybe it's 3 days at the office, 2 days at home, or some combination thereof. And it'll all really be dictated by how safe the environment is relative to the COVID dynamics.
Yeah, anybody seeing something different from what Jim just described?
No, I mean, I'll chime in a little bit here. So Stag's headquarters is in downtown Boston, so it's an urban center. We have a lot of younger employees, a lot of people who commute and rely on public transportation, because Boston has a established and pretty good public transportation system. But I think we've got a number of employees that until there's a vaccine, or until they feel comfortable about getting on the T or a commuter ferry or a commuter rail, we're going to have a challenge getting them back to the office. I happen to be sitting in the office here today. I'm coming in 1 to 2 days a week, and there's out of 75 employees in the home office here. Maybe on a Monday you'll have 8 to 10 people. Today there's only 3 of us. Tomorrow I don't think there'll be any, and Friday there won't be any. So I think we're going to be in that environment for a bit of time. I think it's obviously different if your office is in the suburbs, and I think the suburban offices have seen probably better occupancy of those buildings. But from a technology standpoint, I think this has been one hell of an experiment as to whether you can run a business all being dispersed and working from home. And like Jim, we were fortunate. We had an IT department. We all had laptops and VPN connections and could run the business. And it's forced those people who were probably laggards in using the technology to have to use it. So I guess if there's a silver lining, we've had some people who weren't as technology oriented being forced to use it, and everybody's adopted it. And I think it's working. Just simple things like me. I used to hand sign LOIs. I used to hand sign confidentiality agreements. We used to, notarize leases and everything. Everything's being done through Adobe's, DocuSign now, which allows me to be at home. My in-house counsel being somewhere else at home. Our paralegals being at home. Our counterparties being somewhere else, and all those documents get sent around in PDF. So that's just sort of a small example of how the technology, how we as a real estate firm are using technology that we hadn't used pre-pandemic all that much.
Yeah, so in some ways the technology can kind of help with the efficiency. Max, what are you seeing for you guys? Like you had mentioned maybe on the work from home side that, people are doing okay with it now, but what's coming up in the future? But what have you seen just for you in terms of your ability to do efficiency, volume, so forth with the work from home situation?
Yeah, I mean, for, as an acquisition person and kind of a deal junkie, this is really hard. I like being on the road. I like feeling real estate. I think all of us on this panel are in the asset class because it's so tangible. We're not trading stocks and bonds because we like to feel what we're investing in. We like to understand it. Not being able to do that is really hard, and especially for adaptive reuse projects, not being on site for construction projects or really seeing what's going on live is challenging. We've adapted though. We're looking at Salt Lake City as an investment market for what we do, and I had a 2.5 hour essentially Google Map satellite tour of the city and all the different submarkets and places where you're seeing office growth and where millennials are living, and kind of understanding the different nooks and crannies of the city. So when we see a deal come across from TD or Cushman or whoever, we can understand it a lot better. And if it's in the subset of the city that we want to invest in, we can get a lot more aggressive. So, I probably would have spent a couple days in a city walking it and feeling it to achieve that. I got it done in 2.5 hours. Now, it's not nearly as good as being there, but it does give me some ammo so that when a deal comes across my desk, I can understand it a little bit better.
Yeah, I'll add one thing, Max. I'll add on to what you are. I'm also a deal junkie. I love to travel. I still am traveling, but not nearly as much as I used to, which makes it hard to kind of buy buildings when a big part of your investment strategy is kicking the tires and really understanding the building. There is no technology that's a substitute for that. So we've kind of bolstered what we've done, and I'll give an example. In Milwaukee, we closed on a building a couple weeks ago that we hired a drone company. We're hiring drone companies now on every acquisition, which kind of gives other people here just maybe a belt and suspenders on touching and feeling the building without actually going to the property. We also hired Cushman & Wakefield, Boerke. We had Jeff Hoffman do a site inspection for us, gave him a list of questions that we would typically ask a facilities guy. So we had one of our third parties that we trusted do a site inspection for us because we weren't sure whether we were going to be able to get out during the diligence period and look at it ourselves. I ultimately made a trip and got through the building, but those are the kind of things we're doing as a firm is, the drone videos, having our third parties take more pictures, and then having, whether it's a property management firm you trust or a local brokerage firm that's not affiliated with the deal, doing the site inspection for you. So we're adapting. It's not ideal, but I think it's, as a fiduciary to your stockholders, I think it's the right thing to do.
Well, Ben, Brad teed you up kind of nicely there talking about the partnership. So what about how are you guys using technology, or how are you seeing the technology and work from home experience impacting your ability to do deals?
On the brokerage side, it's been a real adjustment. I think Milwaukee is unique in that the brokerage community here, generally speaking, works pretty well together versus some other marketplaces that I've experienced where it's a little more walls up. We don't want to share as much information here. We definitely have a community where guys are going to work together to get deals done. And so having to work from home, having your staff having to work from home has been an interesting challenge. It's been fun. You're learning new things, right? I mean, I think I'm a slow adapter to some technology, and you're definitely getting forced into just having to learn it and having to use it. So that's been good. I think long run, those are good things that'll help our business and help the community as well. Deal flow wise, how is it impacting deals and getting deals done? I think the relationship piece is huge. We're developing relationships with clients in different ways than we had prior. We touched on it a little bit early on that you kind of get in the, I don't want to say a mundane routine, but within the community here, August is the golf outing and November is this outing, and you kind of had a set schedule of when you knew you would see people and when you could do networking and when you could try and get out and find new opportunities within the group that you're dealing with. And so that's all been scrapped. So everybody working from home, you've had to try and rethink how you want to connect with your clients as well as prospects. And so I honestly think that's a good thing. It's re-engaging us to get out and meet and find deals and try and satisfy client requirements.
Alexi, what's it been like in your circumstances with the kind of a newer, growing company?
I mean, I think everybody's touched on it. Our biggest thing is travel. We're a very partnership and relationship driven firm. When you're signing a lease with a company for 20 or 25 years, you definitely want to see and feel who you're doing business with from a handshake perspective. Our first transaction was a $50 million sale leaseback with Carvana, which you talk about the adoption of technology and e-commerce and people trying new things, where it's really helped. I could say Brad's probably seen a big uptick in technology and e-commerce and logistics driven industrial uses and such. But, for us as a new fund, our biggest thing is touches. And so we've really had to adopt technology and figure out ways to create relationships and to even make aware old relationships, between my partners and I. There's 7 of us in the company. We've done $15 billion of deals in our careers, but getting to everybody and letting everybody know that we have a new flag and a new capital partner has been a challenge. And so for us, that's really what we're focusing on doing. And you could tell everybody we've done XYZ deals and we have XYZ capital partner, but until they see you transact in the market, that's where they understand the level of certainty of execution. And that's a little hard to portray virtually. It's just not the same, shaking somebody's hand.
Yeah, clearly there's a pattern here where we've got sort of this balance of you're struggling with the restrictions on travel and the ability to go and see these buildings and meet these people and keep that part of it going. But at the same time, we're seeing the emergence of technology that is helping kind of patchwork things for the moment. And then maybe, once we get back to where those travel restrictions aren't there, it'll be interesting to see how that technology evolves into the new normal and everybody's every day. We do have a new question that came in from our audience. So this one comes from Sam. What is your biggest challenge for growth right now in terms of assets under management and opportunity to grow portfolio? So Alexi, you still got the hot mic over there. Why don't you take the perspective of, like the newer company for us?
Yeah, for us, I touched on it a little bit, but travel is the biggest one right now. And I would say also M&A activity. So you've seen M&A activity drop off a cliff in 2020, and a lot of that happened, between April and August. Really, you're starting to see it pick back up right now. But for us, until people have some semblance of clarity of what's going to happen in 2021, until they can make board decisions of how they want to capitalize their company, until their lenders come out with, covenant packages of amend and extends or modifications or whatever it might be. Sale leasebacks are highly driven by transactions and capital needs, and they're really a kind of a substitute for debt and equity. And so our biggest challenge right now, until we get to post-election and almost post-pandemic, is going to be what does the future look like? How much capital do we need? Do we want to stay in this property? Do we need to upsize? So there's a lot of questions out there that will be answered by boards. And once boards make decisions and executive management teams make decisions, then I think you're going to start to see transaction volume pick up. And right now, the biggest impetus to growth is that bid-ask spread that we've all talked about a little bit. It's hard right now. Would you be willing to go to a concert venue, or would you be willing to go to Disneyland? Experiential type properties, restaurants, bars, nightclubs, even schools and daycares, dentist facilities. These are all freestanding assets and real estate that need the real estate to make money. And so until there's clarity there, you almost have an entire sector of the market that's almost turned off because the bid-ask spread is so wide. Banks are not necessarily willing to finance something that saw revenue drop off a cliff, by 75 or 80%. Nobody stress tests for zero customers, right?
Right.
Right now, that's where we've seen a massive amount of compression, both from domestic and international capital searching for yield, because you have $15 trillion of negative earning interest rates all over the world. And if you can buy an industrial building in Wisconsin for a 6 cap when it trades for a 3 cap in LA, that sounds pretty darn good. And that's really where we've seen massive compression. It is in the industrial and logistics and e-commerce space. And it's been almost a feeding frenzy in capital markets with any type of credit tenant. If you look at where bonds are trading on financeable assets like Amazon and Walmart and the bigger investment grade tenants, with a 10-year at 80 basis points, you're seeing, paper trade at unprecedented levels, sub 3%, and some of them sub 2%. So I think that'll continue until there's some level of clarity.
Yeah, I think this is such an interesting question because the challenges are unique to every business. What are some of the other panelists thinking, aside from the travel restrictions and the bid-ask challenges that Alexi mentioned? What are some of the other challenges to growth out there that you guys are seeing?
I think from Stag's perspective, we've had lofty acquisition goals the last 2 years. For us to kind of probably meet the 2021 acquisition goal, it'll require probably more properties being brought to market. I mean, there has been a decent amount of industrial offerings that are out there, and this year, after taking a couple month pause, offerings in the marketplace increase. But I think we're hopeful that there'll be more product in the market next year. There's certainly plenty of capital that's looking to get deployed in industrial. So if there's a supply issue, then it's just going to drive pricing, even lower. And I hope that's not the case. I'd like to see some more sellers in the market. Secondarily, I think just keeping the employee base motivated and engaged in a work from home environment is challenging. It's really hard to do. We've never, as a manager, I've never had to deal with this, kind of keeping my team, engaged and connected and keeping the culture. Especially onboarding new employees. We've had a couple new employees this year, and onboarding them is really challenging when you can't walk around and introduce them to everybody in the office. So I think that's a second. I mean, it's a concern of mine. It's probably a little bit more on the secondary side, but it's going to be a long winter for us in cold weather environments or even in warm weather environments. If everybody's at home, it's just going to be a long winter to keep people engaged and motivated. And you won't be able to achieve your goals if your employees aren't connected and productive.
Absolutely. Anything else, Jim, Max?
Yeah, I can jump in here. I mean, that's transaction flow, as Brad kind of referenced. I think that's one of the biggest issues and unknowns is what how much transaction flow will be out there. I mean, it's been really strong in the multifamily sector and in the industrial sector, and looking forward, where do we think we want to grow? Clearly, industrial market's a market we think we need to grow in further and become a bigger player there. So that's where we see some growth opportunities. But trying to figure out, and we're already active in all other asset classes, but trying to see, where is the right place? Should we aggressively go into hospitality right now and build out a platform to capitalize hospitality in a down market? Probably a low cost opportunity today, but is that the right move? Are we going to see that market come back? It will come back to some level, but what is that level and how deep do you want to be in that space, 2-3 years down the road? So it's really us trying to assess where the markets are today, where the growth opportunities are, and absolutely about keeping your employee base engaged. We've been super active with, using Zoom for town hall sessions, and we're doing as much as we can to interact, face to face, so to speak, through this environment as we possibly can to try to continually make sure we're staying in touch with our employees, making them feel like they have a voice and they have an opportunity to engage, with, management levels all the way top down. So that's what we've been trying to do to engage. And And actively, our CEO started a webcast a while back on a weekly basis that's been dramatically, well received. I mean, it's been an amazing elevation for our brand in the marketplace nationally. And we're going to continue to do that and continue to try to find ways to stay connected. I mean, that's the big challenge. And we're going to constantly challenge ourselves to figure out ways to continue to do that effectively.
Great. Well, Sam, I hope that answers your question. We've got one final question for our panelists before we sign off. We're going to give everybody a chance, if they want, to end on a high note here. What are the opportunities that you're looking forward to in 2021? What are the positives and the silver linings that we can take from 2020 as we start looking forward?
I mean, I guess I'll go ahead. I kind of piggyback off of what I was talking about earlier. I think, I'm hopeful that we've got some tailwind coming ahead of us in 2021. I think there's still a lot of uncertainties in play, clearly, with the election and how that plays out and how the markets perceive all of that, and just fundamentally how we handle the transitions, hopefully out of the other side of this whole COVID pandemic, and see where that plays out. I think, the silver lining for us is definitely technology. I think leveraging technology the way we have since the COVID dynamic hit and trying to figure out how best to utilize that on a go-forward basis to make us more productive, more efficient, and really try to identify opportunities to, lead the market as it relates to how we apply technology to effectively engage our marketplace in terms of. So we're going to spend we're spending a lot of time there and trying to really, we don't want to get into technology because that can be very expensive and very unproductive, but really being thoughtful there to try to find how best to utilize technology to support our business on a go forward.
Great. Alexi, how about you? What are you looking forward to next year? What do you take as a silver lining from this year?
I echo everything that all the panelists have said. I know we're in different markets and different industries, but business is very similar from a capitalization perspective, from a culture and work perspective, especially in the real estate business. I think macroeconomically, one of the things that I've been excited to see is, we've been on almost a 10-year bull market, longest in history. We've had downward trajectory on rates. And there was a little bit of froth in the market when we started looking for capital in January, February, March. Crisis always drives innovation, and crisis brings out efficiencies. And so I think this pandemic has really caused companies and people to reassess what's important, and they're cutting the fat, even out of their own lives. In Phoenix, where we live, the weather's starting to open up again. You're starting to see people and neighbors walking around again, and grill in the backyard, and a lot of times in the front yard, where everybody kind of started putting their walls up. And so I'd almost say, from a humanitarian perspective, this has forced people to re-engage in the little things, and you can start to see that in business, where there was a point where I'd make a phone call to somebody I didn't know, and they wouldn't pick their phone up, and now you're forced to, because you're not going to see that person at the conference. You're not going to see that person on the road in a couple months. And so people have almost gone back to the basics in the most efficient way possible. And so, for us as a new company, it's encouraging to see new companies coming out. Like Jim and Brad have said, we're very dependent on transaction volume. And so supply and demand growth drivers are going to be very important for us as transactions continue to pick up.
Okay, well, we're almost at time here, but Ben, I want to give you last word on this question. What are you looking forward to in 2021?
Yeah, I think, ironically enough, Jim and Alexi took all of the key words that I had written down that I was going to use. I think the silver lining really is that it has caused people to reconnect and re-engage in the business. I think, I had a speech a couple of years ago, and I was talking to the association here about brokers needing to get back to the basics and how they do business. And, Alexi's right. We had a 10-year run where things were easy. Things aren't easy right now. And so you're going to have to get back to kind of the blocking and tackling of our business. And to me, that's actually exciting. I think that's the fun part of the business, meeting new people and figuring out how to satisfy client requests, whether it's on the buy or the sell side. So for me, it's coming back to the brokerage side of the business. That's a silver lining for me. I think it's just getting out and to re-engage and reconnect and make new connections. That's the that's the fun, and that's what I'm really looking forward to in 21 as we get some more deals to go through the pipeline.
Well, that's a great note to end on, and we are right at time here. So I'm just going to take this opportunity to thank all of our attendees, our wonderful panelists, and especially our hosts at Cushman & Wakefield Boerke for making this event possible. Thank you all very much. Hope you attendees found today's discussion as informative and engaging as I did, and we will be sending out a recording of today's event. We encourage you all to share that link with anyone who else who you think might be interested. Thank you very much again, and have a great day, everyone.
Thank you.